What's up, everyone? It's Scotty with Money Vesting. Welcome on board for our market open live stream, pre-market right now, and then going into the market open. We do have the very important PPI numbers, producer price index, coming out in now under 10 minutes. If you guys can see me and hear me, just give me a thumbs up. I just want to make sure that the audio and the video is working well. And just give me a thumbs up if everything is working out. And QQQ here right now, we are slightly higher, pushing through a little bit over 68 basis points. We do have the SPY also pushing higher, about 40 to 50 basis points, 50 basis points right now. And the Dow Jones is also up a little bit over 37 basis points right now. So we are seeing a little bit of momentum ahead of the producer price index. This is also the last trading day of the week, and we are still down on the week so far. I think the Nasdaq, S&P, Dow is more or less flat. The S&P, Nasdaq, they're both down on the week so far. Yesterday, of course, we did see a little bit of a momentum to the upside ahead of the PPI numbers. But today, like I said, we've got some very important stuff coming out in about 9.5 minutes, just a little bit under 9 minutes. And of course, that's going to be very, very important for the markets overall. This is the consensus. So 0.2% is expected on a month-over-month basis. And on a year-over-year basis, we're expected to come down to 7.2%. So this is the actual number. So right now we're sitting at 8% for the total PPI for the month of October. And this is expected to come down even further, down to 7.2%. And then total less foods, energy, and trade services right now sitting at 5.4%. We don't have a consensus for that, but I'm assuming it's going to be a little bit under 5% for that specific metric. And then X food and energy, which is core PPI, right now sitting at 6.7%. And the consensus is for us to come down under 6%, although all of those three metrics are going to be going up, or at least the consensus right now is for us to gain a 0.2% month over month for all three metrics. So very, very important, of course, for the market and for the economy. And it's going to set us up for what we can expect going into next week, going into the CPI print on the 13th, and of course the Federal Reserve speech, Chairman Jerome Powell's speech, and of course the interest rate hike on the 14th, along with the SEP, the Summary of Economic Projections as well. So I've got a poll going on right now. Make sure that you do vote if you haven't already. It's a simple question. PPI report will be better than expected, worse than expected, or as expected. So let us know what you think, and you can also vote over there. And then after that is done, we will do like a separate poll for the markets today as well, depending on the reaction from the equity markets as well. The 10-year yields are slightly flat, only down about 43 basis points right now. We're still under 3.5%. We do have crude oil trading a little bit over $72. Crude oil obviously has been selling off quite a bit. It's still down 41% from its highs. It's still down for the month of November, down for the month of December. So that's very good news. For the month of December now, it's down almost 10%, which is, again, incredible news, and we want to see this continue. We want to see oil prices sub 70, sub $65 per barrel. And of course, that's going to be a very good tailwind for the overall inflation prints that come out in the future. Volatility slightly higher, up almost 2%, so back a little bit over 22.7. We'll do a little bit of an audio check here a few minutes before the report comes out, just so we want to make sure that we can hear that. And of course, we will take a look at the BLS.gov. This is the previous report for the month of October that came out in November. And again, we did see an increase of 0.2% month over month for the month of October. And then in October, the rise of the index for final demand can be attributed to a 0.6% advance in prices for final demand goods. In contrast, the index for final demand services decreased 0.1% also. So we have been seeing on a month over month, you can actually come over here and switch this up to 1 month percentage change. And when you hit go, you'll notice that we have been seeing a 0.2% increase month over month for both total less food, energy, and trade services, and of course for the total PPI as well. In the previous month in September, we saw a 0.3% increase, 0.2% last couple months for total. And we actually did see some deflation as well, 0.4%, negative 0.4%. We saw that for total, then it obviously went up to no change, and then 0.2% for the last couple months as well. We were coming down from a significant number, like back in March, it was at 1.7%. That was also the time when PPI pretty much peaked. So once again, if you come over to the 12-month number, this right here was back in March when it was at 11.7%, right? Total was 11.7, and then core, excluding trade services, well, that's sitting at 7.1%, kind of peaked in and around those levels. And since then, we have just been coming down, especially for total. I mean, it's come down from 11.7 down to 8%, and the consensus now is going to be at closer to 7%, 7.2%, which again is going to be very, very good for overall inflation narrative, and the fact that it's already peaked and we're now starting to come down pretty substantially. Just this massive rally, right, coming in from May 2020 all the way to March 2022. So those 2 years, we saw just insane amount of increase in overall producer price index. All right, so we are ready. We got less than 4 minutes now for the PPI numbers to come out. I'm going to do an audio check. Markets are pushing higher. I'm going to go over some of the comments here from you guys. So Oleg, welcome. Victor, welcome. Mohammed, welcome on board. Ray, welcome, welcome. Good morning, everybody. Thank you so much for joining. And let's see, food and energy is irrelevant. Oleg says, I guess PPI will be great. 2 months analysts warning the commodities fall record low. Commodities are key in PPI. So yeah, we'll see. We'll find out here very soon. I'm also expecting some good prints. We should see inflation really start to come down. Amazon, Tesla low at 49, 50%. Do you think more downside capitulation? Don't want to catch a falling knife. Adding a little in position here, Ray is asking. So yes, there was a very interesting chart, and I also did a video earlier, Elon Musk pretty much addressing the sell-off in Tesla stock and kind of highlighting 3 different reasons as to why Tesla's been selling off. So make sure that you do check out that video if you haven't already. But there was a comparison between Amazon, Tesla, Salesforce, a lot of these companies that have sold off 49, 50%. But that sell-off on an absolute basis, percentage basis, doesn't mean anything, right? What we really need to understand is the valuation, what company's valuation is today relative to its actual earnings and fundamentals and revenues, right? A company can drop 80% from its all-time highs and still be overvalued, whereas a company can rally 200% and still be undervalued, right? So there's a lot of different case in points here that just because the stock price has fallen 40%, 50%, or it's gone up 100%, 200%, doesn't mean it's a bad buy or a good buy. What we have to focus on is the valuation and what's the intrinsic value. So with that regard, I think Tesla in the 170s really starts to become very attractive, considering they are able to maintain that demand and production and delivery numbers for 2022 and of course for next year. I think next year is going to be the big question mark for Tesla's deliveries because again, we did some math. They need to do 2 million vehicles in 2023 in order to get up to 40-50% compounded annual growth rate. 2 million vehicles in 2023 in an environment where interest rates are going to be higher, consumer spending is going to slow down significantly, and excess savings are going to be coming down. It's challenging. Not saying that it's not possible. It's challenging. It's possible, but it's going to be difficult for them to do that, right? So again, it's going to be something that we will analyze as time goes on, and we'll see what deliveries look like for Tesla. All right, so let's see. Big smile, please. It seems like you're damn serious today, Satish says. Excellent video on Tesla earlier this morning. Thanks a lot. So really appreciate it, and make sure that you do check that out if you haven't already. And yeah, super excited. I'm not serious. Super excited for these PPI numbers to come out in about 1:30. And again, that's exactly why we're doing this live stream, is just to make sure that we are on top of all these numbers. So I'm going to do an audio check here. Just make sure that you give me guys a thumbs up if you guys can hear this as soon as this comes back in. I'll play this and just so the audio is working, and we should be all set with that. So where are we on the poll here? 48% expecting. Make sure that you do vote. We've got 400 people watching, only 200 votes, so there's only 50% of people participating. So Oleg says 2 minutes till plus 7% on the NASDAQ. Oleg, man, I love the optimism always. It's like on a whole different level. But 48% expecting better than expected PPI numbers. 27% worse than expected, and 26% expecting as expected. So majority of investors right now currently expecting the numbers to be much better than what the consensus is right now. Again, this is the consensus. We'll reload that in about a minute here. And then we'll also take a look at some of the items individually within the PPI report as well. So hope you all are ready. And markets are going to be moving. I mean, they're not going to move as much as they do on CPI. CPI is certainly the bigger catalyst out of the two, but PPI also gives us a little bit of indication. What moves you? Give me a thumbs up if you can hear this.
Welcome back to Squawk Box right here on CNBC. We are just a few seconds away from the November producer inflation data. The number that is anticipated for the month is up by 0.2%. Again, this is inflation as measured in producer prices, so that would mean it is a little further up the pipeline before it gets to the consumers. You're hoping to see a smaller number there to indicate that inflation is really starting to come down, and that seems to be what the market's expecting today too. Dow futures up by about 150 points, NASDAQ up by 80, the S&P up by 22. The 10-year note last we checked was yielding just about 3.476. Rick Santelli is standing by at the CME. Rick?
Yes, for November on headline producer price index, what we have is up 0.3%. Strip out food and energy, it is up 0.4. That's a bit hotter than expected. And this one's very interesting because up 0.4 on month-over-month core was 0 last month. It was 0. So we have moved higher there. That's significant. And if you strip out food, energy, and trade on a month-over-month basis, expecting up 0.1, it is up 0.3. And in the rearview mirror, 3 out of the last 4 months outside of November were only up 0.2. So heating up there as well. Now, my favorite, the year-over-year numbers. On year-over-year headline or final demand, 7.2 expected, 7.4 is what arrived, and the rearview mirror is 8%, and the high water mark here is 11.7. The high water mark actually across the board for PPI was all March of this year. That one was 11.7. So you can see that we've come down, and 7.4 is the lowest level since that number. And if we go to 6.2 for core year over year, that was expected to be 5.9. So also hotter than expected. But is expectations really what's in the market, or is it where we've been? And the rearview mirror is 6.7. So 6.2 and 9.7 in March, you can see we've made progress, but we're still historically high. And finally, the last year over year number, X food, X energy, X trade, expected to be up 4.7, is up 4.9. So the expectations on all numbers, monthly and year over year, were all higher than expected, but they were all tame on the year over year. So 4.9, how does that stack up? Well, 4.9's high water mark in March was 7.1, and the rear view mirror is 5.4. So we have to watch the market, and we've seen yields move up. A 2-year note yield is right around 4.25. It's moved higher. A 10-year note yield was around 3.46. It's moved higher. But let's consider the facts on a weekly basis. 30-year bonds closed last week at 3.55. They're at 3.47. 10-year notes last week closed at 3.49. They're hovering at 3.50. 2-year notes last week closed at 4.27. They're at 4.29. Those weekly numbers give you a nice glimpse of a week where the Fed speak continued to try previous week push rates higher and equities lower. They were only half successful on the equity side. And of course, we have CPI next week. These numbers will be the capstones before the Fed decides whether they're going to move 0.5%, 50 basis points, which is what the market seems to expect. As you pointed out, Dow futures have moved lower. We'll see if these knee-jerk reactions on higher than expectations prove to be staying power here. I personally think that if you look at the trends, and they don't necessarily need to be linear when you're looking at inflation, that the trends are still in favor of the way the market and the yield curves have moved of late. Becky, back to you.
Okay, Rick, thanks again. As Rick mentioned, we're looking at those Dow futures down by about 140 points. This comes after they were up by about 150 heading up to this. So you're looking at about a 300-point swing. We'll continue to watch this on a tick-by-tick. But for more on this data right now, we want to bring in our very own senior economics reporter, Steve Leisman, along with Megan Green, who's a chief economist at Kroll Global, and Chris Bitterly, who is head of North America investments at Citi Global Wealth. And Steve, let's start with you. What does the Fed take out of this? I've got to guess that ex-food and energy number up 0.4% is going to be something that causes a little bit of concern.
Yeah, but you know what, Becky? I think this may be a better number than it looks like at first glance, and I'll tell you why. A couple reasons. First of all, I don't know, and I can't really explain it. We have a surge in food prices. I'm not sure where that's from, but it was unexpected. The big swing factor in all this, Becky, is the trade services number. It's kind of a fudge number. It's kind of a real number. It's essentially, it's a profits number or a margin number for wholesalers and retailers. It's up 0.7%. It has come down year over year, but remains relatively high. And I think the expectation, I think it's the correct expectation, is that these numbers are going to come down as prices come down. Also, you had a 3.3% decline in energy. I think there was an expectation for there was going to be more of that. You look at what happened to gasoline prices in November. They came down pretty sharply. They're still coming down. And one other thing, when I look up the food chain, I look up to processed goods or unprocessed goods, I see negative numbers coming down the pike. So the headline did not do what was expected. I think you look a little bit into the numbers, and I think Rick kind of said it. This is in the direction of where bonds think inflation is going. Not precisely what that was expected, but I still think it's a decent number that is in the right direction of where inflation needs to go.
Megan, do you think this has any impact on the Fed next week? Or are we kind of baked into this idea of a 50 basis points with a hawkish sentiment surrounding that?
Yeah, I don't think this has any bearing on what the Fed's going to do next Wednesday. It was a slightly stronger report than what we were hoping for, that's for sure. But it won't shift the Fed off of a 50 basis point hike next week. I think Steve's right to point out that the trade services piece is the most interesting piece in the PPI report, largely because it's imputed from margins. And so it's coming down, still fairly strong. That says something about companies' margins that are still pretty strong. So that's not all bad news. But, PPI used to be considered to be something that leads CPI. That hasn't really been the case. It sort of moves along CPI. And so it was stronger, but I don't think that means that CPI is going to be that much stronger. I think peak inflation is probably behind us. Also, this PPI report was driven mostly by services inflation. That's something that the Fed will pay attention to. They're really worried about services inflation because there's a huge wage component in that. And so insofar as it's really strong, the Fed will worry that wages then will be really strong, and you could end up in a wage price spiral. Looking at the jobs numbers, the jobs report suggests that wage growth has re-accelerated. That's bad news for the Fed. But I don't think we're really in a wage price spiral. It's just something to watch out for.
All right, Chris, take all of that as an investor and try and figure out what to do ahead of this. We've seen some pretty active movement in the futures, seen some pretty decent moves in the yield of the Treasuries complex this morning. But as Rick points out, we're not back to the levels we closed at last week when it comes to, at least to the Treasury yields.
Yeah, this has been a big question, and it's super interesting just looking into the end of the year, which only we...
All right, so we did get much worse numbers than what the expectation was. 0.4% on the final demand. So like total numbers, 0.3, 0.4% was the actual number here. Let's just take a quick look. So again, if you go back up that report, final demand PPI for the month of November was up a little bit over 0.3%. And then final demand prices rose 0.3%, both for October, September. And then 7.4% was where we were for the actual numbers once this thing loads up. So definitely much worse. And services was not the key component there. I think it was mostly food. If you take a look at food month over month, 3.3% on a month over month basis. Take a look at that spike from October to November. That was a pretty substantial spike here from 0.8% to 3.3%. So as a result, when you look at final demand obviously going much higher, and then core also going up. So I think what they mentioned was for core, services was the key component there, pushing up also up 0.4% on a month over month basis. Energy was down as expected. It was supposed to be down, and it was down 3.3% negative month over month. So that's good. And goods here also down 0.1%, still up 0.1% from 0.6. So coming off from its highs. So both goods and energy was down, but when you look at core, services was the main culprit there, going up 0.4%. And then when you look at total final demand, food definitely going up. And when I was looking at this report here, food was up 21%, specific one category here, up 21% on a month over month basis. Absolutely astronomical from October to November. And this is finished consumer food right here, which is substantial. And that year over year, it's up 61.7%, which is the most compared to any other item over here. Energy was down. So if you come down a little bit, you'll notice that energy, wherever that is, was down. Let's see. Let me just see if I can find it. So there we go. Energy down a little bit over minus 3.9%. But food was up 1% for this specific category under goods. And then, of course, services also pushing higher. So overall, the report was certainly not as great as what the market was anticipating. So 0.3% increase month over month versus 0.2. Year over year, 7.2% expected. We came in at 7.4, so a little bit shy of expectations there. Ex-food and energy, again, because of services going up 0.4%. And then ex-food and energy year over year, we actually did not come down sub 6%. We actually came in 6.2. And then ex-food, energy, and trade services, 0.3% increase versus 0.2. And ex-food and energy trade services year over year coming in sub 5%. So overall, I would say the numbers were actually better than what the previous month was. So it's not like we're accelerating to new highs. We're actually coming off. Month over month, I think was a little bit tricky because this number right here, mostly driven by food, 0.3%. And then ex-food and energy driven by services, which was twice as what the expectations were. But of course, on a year-over-year basis, simple math, we're coming off of those highs from 8% down to 7.4. So you can see that on this separate chart on a 12-month basis. You'll notice that we are coming off pretty nicely, right? So we've come off from 8.1% down to 7.4. So that is still something to look forward to, like as inflation's peaked back in March from 11% now down to 7.4. But we're still seeing month-over-month gains, which is, a little bit higher than what the expectations were. So market's not taking that as celebratory, like they're not in celebration right now. Nasdaq here selling off down 36 basis points, pretty much given up on all those gains. And this is a pretty substantial move, right? This is a 1% move because we were much higher. Actually a 1.3% move because we were higher 60, 70 basis points before the report, and now we're just selling off. And same thing with the SPY as well. Coming down a little bit over 1%, and the Dow also tumbled close to about 200 points or so, down 0.3% right now. So that's where we are. And again, this is a little bit of a precursor going into the CPI print next week that comes out on the 13th. This usually does happen when PPI either comes out after CPI or it comes out before. This time around for this month, we are coming in before the CPI prints, and the next week, of course, we get the Fed rate as well. I doubt there's going to be any changes to the actual Fed funds futures. We can take a quick look, but we're still expected to see at least a 50 basis points hike from the Federal Reserve. That's at least where the majority of the consensus is right now, sitting at roughly over 75% last time I checked. Right now we're at 74.7, so almost 75% consensus for a 50 basis points, and a very small probability for us to see a 75 basis point hike going into next week as well. So overall, I would say numbers were decent. We didn't come in what the expectations were, but I also think the expectations were a little bit too optimistic. For us to go from 8 to 7.2%, I think in 1 month was a little too asking too much. And 0.2% I think was reasonable, but obviously coming in much higher because of services and food there. And then core also going up because of services going up 0.4%, which is quite a lot here. So services inflation and food inflation definitely driving substantial gains for overall inflation. Energy came down, that as expected, that was supposed to come down. And I think that's also going to be reflected in the CPI report. But yeah, that's where we are. So, okay, let's see. Now let's just do a quick poll on the markets. We're going to end this one. We got some good votes. Lots of people expecting. It was pretty much a nice split, but majority still expecting better than expected. But we did come in in line with those 36% people that expected worse than expected numbers from the PPI numbers. But let's just do another poll here for the markets now, considering that we just got our report. Yeah, Mohammed says no need for the poll. That's how brutal, that's how bearish we are. But let's just do a quick poll here and see what the consensus is. There's still a possibility. Look, there's many times we've seen the markets gap down pretty heavily, and we've seen the markets kind of rally intraday to kind of fill that gap in, and then possibly even push higher. But we'll see what happens today. From a technical standpoint, of course, we're still kind of battling through that lower high. We still got those moving averages, and S&P already had a nice 10-15% move to the upside since October. So right now we're kind of battling through that resistance here, where this is the fourth retest where we're getting rejected for the S&P, and we're now starting to sell right back down once again. We've talked about the valuation. We've talked about the bird's eye view for the market. We've talked about sort of like these Excel spreadsheets where this is where we're sitting right now, considering the S&P 500 right now at 3963. We're right now sitting at about a valuation of about under 18 times, right? A little bit over 18.3 times earnings multiple for 2023, considering an EPS of $216, which in my view, I think is still pretty high. And as I already mentioned, I think we need to recalibrate down to closer to 14, 15 levels. And that would represent an S&P value of about 30 to 3,300. Worst case scenario, we come down to 3,000, and those are some levels to pay attention to. Now, of course, that's not the most popular viewpoint, or that's not the most loved, but this is the most objective I think I can be, just considering the valuation of the overall market, considering an environment where interest rates are higher and earnings are going to get affected eventually, potentially coming down as well. So we just have to take a look at this number right here and where that ends up sitting, and whether it's aligned with the current environment, whether it's too high, too low, or fairly valued appropriate in the markets. And I think at 18.3 right now, we're still a bit too high for the market. So yeah, that's where we are. Volatility here with a little bit of a push. 2.65% yields also started pushing higher as soon as the numbers came in. So this is the spike that we got on the 10-year. We're back over to 3.5%, and the dollar index also pushing higher, back up to almost 105. It actually got up to 105, and now we're just rolling right back down a little bit. But like I said, we'll see what happens throughout the rest of the day. Last trading day of the week, we're still down on the week, so should be interesting. Yes, DXY is exploding. Let's see. I am under the weather, so if I do sniff or sneeze, I do apologize because I have been kind of battling through this ever since I got back from Qatar last week. It just from all the screaming during games and from all the cold drinks, it was just yeah, I just caught a cold. Tony says, "Hang in there. This too shall pass." Alex says, "Santa lost everything in the stock market already, so he's not coming this year, maybe next year." Yeah, so we'll see whether there's a Santa rally or not. I think there is going to be a narrative around a Santa rally, but I think there's a couple things that do need to line up. The technicals, first of all, certainly need to be lined up. Right now, I think there's no reason for the markets to get a big breakout unless, of course, we get a significantly dovish tone from the Federal Reserve next week and inflation numbers come in much better than what the expectations were. I think that's going to be a big catalyst for a potential technical rally. And of course, the technical setup, if we do get a breakout above this 200 SMA and this lower high, then there's still a possibility. But if none of those things happen, then unfortunately, yeah, we're not in for a big technical rally for this year. So Caddy, why should deduct S&P 500 at 7% down to 316? Murich, are you talking about 216, the EPS, or like, because I don't have 316, I have 216 as the value for earnings per share for next year. Right now, the analysts have them at 232. That's what the consensus is sitting right now among all analysts, $232. And I've had questions asked about where that EPS is coming from. That's an earnings per share across all 500 companies within the S&P 500, right? So we take a very simple weighted average of the actual earnings of the S&P 500 from all analysts, what the consensus estimates are. And of course, you got the value of the S&P 500, so you divide those two and you get a multiple. The reason why I'm taking 216 is because on average, analysts have been overestimating earnings per share for the S&P 500 about 7%. So they've overestimated 7% of the earnings per share for S&P 500. So I'm kind of shaving off that 7% already and getting down to 216. So that's going to be that number. So 232 times 0.93, get down to 215.76. I'm just rounding that up to 216. So that's that number that I'm taking into account. So if I don't do that and eventually it gets revised down, then that's a bigger problem, right? So I'm already kind of ahead of that overestimation, 7%, already shaving it down to 216. Hope that makes sense. And the reason I'm doing that is because the probability for these analysts to be overestimating is quite high. Does anybody remember, out of the last 25 years, how many years have analysts overestimated earnings on the S&P 500? I did a video about this. Specifically, I mentioned this stat. I want to know if anybody remembers. Pop quiz. Out of the last 25 years, analysts have overestimated the S&P 500 earnings. How many years? Who says every year? No, they're not that bad. They're not that bad. They haven't. So 7% is how much they've overestimated earnings by, but out of the last 25 years, how many years they've overestimated? Let's see. 18. So Justice says 18. Yes, so 18 is the correct answer. 18 years is the number. So 18 divided by 25, I think it was, yes. Or was it? Yeah, so I think it was 17 to 18. It's somewhere between 17 and 18 years, which is a pretty substantial number, right? You're talking 70%. Yes, so Musicful says 70%. 18 years, 17 years. Yeah, so it's 17 to 18%, or almost 70%. That's a pretty substantial number, right? So majority of the years, analysts have overestimated the earnings per share, which is exactly why I'm kind of being skeptical here with their $232 for 2023. Where are you from? I'm originally from India. I am in India right now, and I did enjoy my visit to Qatar. It was absolutely phenomenal. Loved it. The organization for the whole World Cup was very, very good. So yeah, that's where we are. 70% or 17 to 18 years, correct. Yeah, so that's where we are. Markets are rotating a little bit. We're not down as much, right? So we're expecting what? 53% people expecting the markets to be red now, 30% expecting green, and 17% flat here. So we are seeing a little bit of buyers to step in. Apple here is down pretty much flat, not really a lot of movement, and Tesla is up. Surprisingly, Tesla is green, 21 basis points. We never thought I'd see Tesla green again, but Nvidia here down close to 59 basis points, and AMD is also down 67 basis points right now. So we're not seeing a lot of momentum on the downside, even though inflation PPI for specifically came in a little bit worse than expectations. We're still seeing markets kind of hold up a lot better. So Lululemon reported earnings, Costco reported earnings. I'm going to be doing videos on both of them. Lululemon specifically actually ended up beating both earnings and revenue, but it's still down over 7.6%. So let's take a look at their numbers. So they expect Q4 diluted EPS of 420 to 430 on revenue between 2.6 and 2.65 billion. And for the full 2022, they expect EPS between 987 and 997. So call it 995 just as a mid guidance for the company, and the price right now at 346. So 346 divided by 995, we're trading at a little bit under 35 times earnings, which is still expensive for Lululemon, right? 35 times earnings for this company is still quite high. So it's a good thing that it's selling off. I think we need to see Lululemon in the 250s, possibly even lower. I would love to see it roughly sub $200. This is a stock that is on my watch list for a potential buying opportunity, but it's just incredibly expensive from a valuation perspective. But the brand itself is very strong, consistent revenue growth, earnings growth. Year to date is kind of held up really well. It's only down 4% at the moment. So again, down 7%, which is good. They beat on revenue, beat on earnings, but I think the valuation is still too high for us to own this one. Costco here also selling off a little bit. It did beat, actually missed on both earnings and revenue. This is the very interesting technical setup for Costco, right? So if I remove the moving averages, you can see that we're just kind of inside this symmetrical triangle, making lower highs and higher lows. So we're just consistently in this pattern where it just sells off, pushes higher, sells off, pushes higher, sells off. And we'll see if it continues to kind of validate these levels and kind of coil inside this symmetrical triangle, eventually to break out or break down in either direction. So right now, just look at what happened yesterday, right? Just perfect validation down to 473, and then buyers really stepping in to push this back over 480s. So right now, pre-market just more or less flat. So we'll see whether it starts to break down or starts to push right back up. So what is good EBITDA for Lulu? You mean like an EBITDA multiple, or you mean just what is their EBITDA? Like if you want to look at their EBITDA, you can simply go to their income statement and you can take a look at their earnings before interest, taxes, depreciation, amortization. Just let me see if TradingView actually has that. I doubt they have that, but maybe they do. Oh, they do. So their EBITDA is 465 million for second quarter. For last year, it was a little bit over 1.6 billion. That was a 60% growth on a year-over-year basis. So this is their overall EBITDA line. This right here is their overall EBITDA for the last 6-7 years. So that's what it is. And then if you take a look at statistics again, right now 43 times earnings, but that's also not considering the overall 2022 numbers. A little bit under 7 times sales, and enterprise value to EBITDA multiple is at 28, which is certainly a lot higher than what I would like to pay for them. Yeah, can you check Enphase's chart? It keeps on hitting 52-week highs. Enphase here was up to 319, 320. I've done a video on Enphase, so make sure that you do check that out. And I do think that in the short term, I'm definitely going to look very stupid just kind of talking about Enphase being a little bit overvalued. But I think long term, the valuation is going to catch up to the price, and sometimes it takes time for the actual valuation to play through, and we've seen this kind of happen in all of 2022, where a lot of the companies that were doing really well, that were just thought to be the perfect companies that could never sell off, and now we're just kind of like, can't believe our eyes that these prices are coming down. Like they're selling off to these levels, right? Tesla, we never thought would come down. Well, we had an intrinsic value, 150s, 170s, but it's now coming down to 170s in reality for a stock when it was trading at $350 plus. So I think Enphase is going to be in a very similar situation, maybe 2023, and I think that's true for a lot of energy companies as well. Just like what happened with Zim Integrated Shipping, right? This is a very good example of what happens when your earnings start to really decline or not go up as much as what investors were hoping for. Another case in point is Upstart, right? Upstart was the most loved stock of 2021. It was doing the best, and then October of 21, recession, like pretty much the loan activity starts to come down, interest rates start going up, and then all of a sudden you've got poor revenue, very difficult comps, earnings start declining, losses start generating, and then look what happens to the stock price. So if it's if it's not sustainable, you have to be very careful. When you take a look at these parabolic growth, revenues and earnings, you just have to ask yourself, is this something the company can replicate every single year, right? Can Enphase keep generating 40, 50% growth in revenues and earnings? If the answer is no, you want to be very careful with that valuation, because if the earnings start going down, all of a sudden a fairly valued stock can be overvalued based on the multiples. So you got to be very, very careful with those things. Okay, so Oscar, we don't have the CPI today. Nick, what are my thoughts on CPI? I will be doing a video over the weekend. CPI is on December 13th, so that comes out next week on Tuesday. So yeah, CPI is not going to come out today. CPI comes out next week. And today we had the PPI numbers, so producer price index, and then yes, market opens in about 34 to 35 minutes here. So Carlos Caddy, what actually do you think will happen with ZIM? So actually, there was another question I wanted to answer first before I get to ZIM. Let's see. What was that question? Why are we down? You hear the positive reaction on TV for confirmed downtrend. Yeah, I think we are pushing higher a little bit. I mean, we are starting to see some momentum. I mean, S&P's, NASDAQ's only down 24, 25 basis points. Like, I wouldn't chalk this up to being down. I think it's more of a flat open. So we're not really gapping down substantially. We were, but we're starting to kind of push back up here. So anyway, for Zim Integrated Shipping, I think we have to kind of go back to the drawing board and look at what the valuation is for this company. Because, like I said, the dividend yield at 148% now, right, can be very delusional, because I've been talking about this. I've done videos on this, why you need to be very careful for this stock, because again, the dividend yield can be delusional. And, like I said, there's no free lunches. Markets sees that. They recognize that. And I'll do like an updated video on this, see where the valuation ends up being. Right now sitting at roughly a little bit over $18 per share. So we'll do an analysis on them. So David, PPI and CPI differences. The main difference is that PPI relates more to producer prices, what producers are paying for raw materials and input costs, and CPI is more towards the consumer, right? The consumer price index, like consumers like you and I, and what are we paying for those end finished goods and services like we consume on a regular basis. So that's the main difference. PPI, remember, P stands for producers and what producers are paying for those raw materials and input costs, wholesale prices, so to speak. And then CPI, C stands for consumer, which is like you and I, consumers paying for the end product on an everyday basis. So yeah, so Oh My Lord says PPI, P stands for merchants or producers, CPI stands for consumers. All right, so we were talking about a couple other stocks as well. So NVIDIA, I've already shared my thoughts. Ulta, I was actually taking a look at that stock today. That just keeps on hitting new all-time highs here. We've got a very overextended chart. RSI MACD extremely overbought here, but I was looking at the stock today. I was like, wow, this thing has done really well. Ulta Beauty, like apparently there's still demand for beauty products. And that thing just keeps pushing higher regardless of what is happening in the economy. So let's just take a look at their earnings. They reported just a couple days ago, beat on revenue, beat on earnings. I'm more interested in what their forward earnings multiple is for this company. So Okay, so 2022, they're now expecting diluted EPS of 22.60 and 22.90 and revenue between 9.95 and $10 billion. So if we take into account, let's just do $23 just to be, rounding up these numbers. $480 divided by 23, 20 times, like 21 times earnings multiple. This is after the stock has already rallied over 30%, and a case in point again, just because the stock's rallied 30% doesn't mean it's a bad buy, right? Doesn't mean it's overvalued or anything, right? Even after the 30% rally, Ulta is trading at 21 times earnings, which is far better than Lululemon, which has dropped 10% and still trading at 35 times earnings, right? So these percentage drops on an absolute basis, whether it's going up 20% or down 30%, mean nothing. What really matters is what valuation they're trading at based on the market cap, based on the price itself. So Ulta, from a technical standpoint, might still be overextended and might be due for a pullback. So this is certainly not a place for me to go long on Ulta, but fundamentally it starts to make a lot of sense when it's trading at, even at $24 billion market cap divided by 10 billion in sales. That's 2.4 times sales, right? That's the price of sales multiple that it's trading at, which is very reasonable, right? And let's take a look at the margins. Margins, we've got 11% margins, 9.5, 9.8, 9.4. So it looks like they've been doing 10 to 11% margin with that dip in 2020 because of COVID. So margins are good, 10 to 11%. And we're trading at under 2.5 times sales and 21 times earnings. Fundamentals make a lot of sense for this company. It's actually trading at a very reasonable fundamentals, but of course, technically it's a little bit overbought. Milan says, gals buy more lipsticks. Yeah, I mean, I feel like that's one business which is gonna always do well. It's like beauty products, right? Because I think people are still gonna buy beauty products. I feel like that's recession proof to some extent, even though it's like a discretionary spend. I don't know. It's more of a need, right, for people, so they're still gonna buy it. Okay, so let's see. Yeah, CPI has a much bigger impact than PPI on inflation. That is correct. A CPI have a much bigger impact, always does, than producer price index. So again, we're gonna next week is the prime week. It's the week where we need to be paying attention to what the CPI numbers ends up being, and of course the Federal Reserve's speech. The SCP, the Summary of Economic Projections, that is going to be very important as well. And whatever Jerome Powell says, because every word is going to be dissected in a million different ways from the market. So whatever he says, whatever tone he uses, how he responds to questions, I think everything is just going to be detailed, like from the market. It's going to be very, very intense. All right, so let's see. On Semiconductor, I've done a video on them, T-Ranks, on Semiconductor. So if you simply search money vesting on Semiconductor, you will find a video on them as well. But overall, I think this is another company that has done really well in 2022. I mean, it's up 5.3%, so it's obviously doing much better than the market. And then in terms of valuation, still low, right? We're trading at 12.5 times earnings. Actually 12.5 times cash flow, 18 times earnings, under 4 times sales, and a little bit over 10 times enterprise value to EBITDA. So those are very, very attractive valuation multiples, despite the fact that it's trading at all-time highs pretty much. So again, full detailed analysis is on the channel. You can check that out if you haven't already. On Holding, is that a different company? Okay, so it is a different company. So I was getting confused a little bit. All right, so we are, for this company, 5.5 billion market cap. We are not profit making, although the last 3 quarters have been profits for this, which is good. Down 53% year to date. We don't have any other multiples except for price to book, which is at 5.84, but the market cap is at 5.5 billion. The revenue last year was 792 million. So let's just do some quick math here. 5,500, 792. It's trading at a little bit under 7 times sales based on a trailing basis for last year. So looks like it is a consumer non-durables apparel footwear company. So I might have to do some research on them to see if there's any opportunity here. But bottom line is revenues are growing, but losses are growing as well. Although the last 3 quarters, they have generated profitability, which is a good thing. And then based on the balance sheet for the company right now, we've got more cash than debt, which is good. So net debt is negative $128 million. That is good. That's what we like to see. And then shares outstanding have been stable. Yeah, they've been stable. They haven't really been going up. They've only gone up from 305 million to 311 million over the last couple of years, which is also a good thing. So overall, I think I like what I see, but except for the profitability aspect of the business. But recently they have been turning the corner over the last 3 quarters. So something to look into for me on this stock. So 1550 is going to be that support at the moment. All right, let's see. There's a lot of stocks I need to go over here. AYX, Amazon, NEO, Broadcom, TSMC. So I have done a video on TSMC. I haven't really done the earnings update on them yet. So you can check that out. AYX does sound familiar. I think we have done the analysis on this company during our private live stream, if I'm not mistaken. I think AYX was part of that list. I could be mistaken, but I'm pretty sure we did some analysis on AYX. So if you are in our Discord, who is asking this question on AYX? If you are in Discord, yes. So Frank, we did an analysis on AYX, literally the full analysis, the fundamentals, the technicals. We did an entire analysis. We also put together an intrinsic value for the stock. I'm pretty sure if anybody watched our private live stream, just confirm that we did an analysis on AYX. But I'm pretty sure we did. It was part of the list. But you can find the full analysis there. I'll confirm. I'll have to go back and rewatch it. It was like a 3-hour live stream. Not this past weekend, not the weekend before that. Actually, the weekend before this one. Yeah. Just today is Friday. Not last weekend, but the weekend before that. We did an analysis, private live stream for all the members, and we did go over AYX. And TSMC, like I said, we have already done a video on them as well. NEO, we've talked about. Yeah, so we covered that in the private video. Kevin, thank you so much. Man, you're a legend. Yeah, so we did analyze AYX, and we also put together a fair value on that stock. NEO is kind of battling through a big resistance right now. As I've already mentioned, $12.95, closer to $13 is going to be that level. So, right now kind of fighting that resistance here. We're just kind of struggling to actually break above this level, although yesterday was a very good day, up 6.6%. So, right now we're just kind of battling through that. And the next resistance is going to be $15.80 to as much as $16 for NEO at the moment. I see a lot of questions about Tesla. God, I'm just like, I need to sneeze so bad. So Tesla here down 11 basis points. Lots of questions about Tesla. And you need some orange juice for that cold. It's because I'm drinking all that cold orange juice, Kevin, that my throat's gone. It's because of all that cold orange juice. That's what's causing it. No, but you're right. I need to get some vitamin C to feel better. Stream it with Vicks. I do put that on like when I go to bed, but not right now. I'm not gonna put on some Vicks right now. Anyway, so Tesla, Elon Musk already identifying 3 things. What's been wrong and why the macro situation is really difficult. So you can watch that video, but this is our intrinsic value. Tesla in the 170s right now is pretty much flat right now. It's come down to this level twice. It was at this level last week of November, like November 22nd, 23rd. And right now it's pretty much down to those levels again. And this is more or less my intrinsic value for Tesla, right, in the 170s. But of course, it's very sensitive to what the future looks like for this company. Now things are deteriorating, like especially in 2023. I think we're gonna find out more when it comes to consumer spending. What happens with those excess savings, which will run out in the middle of next year. We already know that. And consumer credit's at an all-time high. Credit card debt, of course, the interest rates are going higher. So there's going to be a lot of potential headwinds that are already brewing and will become more apparent in 2023. So, can Tesla, first of all, deliver close to 1.5 million vehicles this year? Let me know what you think, if they can actually do that. And then the next question is a follow-up question. Can Tesla actually deliver 2 million vehicles in 2023, right? That's the bigger challenge for Tesla, is that can they actually get up to 2 million next year? So those are the big questions there. If Tesla can achieve those numbers, then absolutely, no doubt, 170s, for me personally, it's a buy all day long. But if macro challenges become more severe, if conditions tighten even more, and if they're not able to produce or deliver, or the demand starts to slow down, right, or competition heats up, then of course those are challenges for the company that we need to address, and that will lower the fair value just based on revenue. But even then, I'm taking a very conservative revenue growth, right? That's exactly one of the good things about our analysis, is that we're not over optimistic. We're not even optimistic. We're just conservative with the estimates, right? When I'm not taking 40%, 50% growth for revenue, I'm only taking 30%, and I'm applying even a lower multiple of 25. And even if Tesla can achieve the bare minimum 30% growth in revenues or net income, so to speak, even then that's fine. Tesla starts to become very attractive at these levels. But of course, if Tesla doesn't even do that, then yeah, we're definitely going to have to reevaluate. So yeah, Srinivas says demand for Tesla in 2023 might be challenging as customers holding off on spend. And like I said, it's going to be in 2023, I think there's going to be a big flip where the economy might actually start to show the cracks, which is lower spend, economic slowdown, earnings actually start to come down, and estimates are already starting to roll down. Unemployment might start pushing higher, but the market, I think, is going to be a much different situation, especially in the first 6 months. There is, I think, going to be some pain as the economy starts to really get affected by these higher interest rates. But then as the Federal Reserve makes that decision, what to do with interest rates, and of course we'll have to keep track of inflation. And like I said, they're really hoping, the Federal Reserve officials right now are hoping that by the time the economy breaks down, by the time unemployment starts pushing up, inflation is back under control. Because the last thing they want is to make that decision between their dual mandate. The last thing they would want is higher inflation and higher unemployment. That's the worst scenario to be in as Federal Reserve. So yeah, that's those are my thoughts on Tesla right now. 172, just more or less flat here pre-market. We're seeing markets start to kind of roll right back over. The yields pushing up 1%, 3.5% is where we're at right now. Got about 18 minutes left for the markets to open. Volatility is up 2.5%, and of course the yield curves are all still pretty negative. The spreads are, and all yield curves are inverted. And yeah, that's where we are for the market. Side says, can you talk about AMC stock, or should we sell on loss? So AMC, I've only done one video on the channel, which is dedicated to AMC stock, and that's about it. So again, I haven't been following up with this company. The only time I talked about this was to inform everybody what's going on, and this was about a couple of years ago. But since then, we've done some brief analysis on technicals every so often on live streams, but I have no idea what's going on with this company, to be honest. I don't know where the short interest is, what's going on with their other, whatever it was, I think it was APE, the preferred equity. So, wow. Yeah, this is the first time I'm looking at this chart in months. So, yeah, I mean, it's sold off. I mean, this has been a part of the other AMC as well. So I couldn't offer any analysis on AMC. Even if I would, I would be off because I have no idea what's going on with the company, unfortunately. So yeah, I haven't been keeping up. Although it looks like they have been beating revenue and earnings estimates. So it does look like they might be on the right track. But like I said, I'll have to dig in deep to look into this company. So Netflix is higher, 2.5%. Let's take a look. So 17 hours ago, Walt Disney launches ad-supported streaming subscription in the US. There we go. Walt Disney also kind of copying Netflix on their basic with ads plan, Disney Plus. And it's kind of funny because all these streaming companies were there to disrupt the TV, the normal television, and the ad-supported sort of way of watching your favorite shows and movies. So when they went into streaming, where you can pay a subscription and not watch ads, and now they're kind of full circle. They're now starting an ad-supported tier where you pay to watch ads again. It's just it's crazy, right? But desperate times ask for desperate measures. And that's what happened. That's what's happening. Disney Basic Plus costs $7.99 a month alone, combined with Hulu's ad-supported tier, $9.99 a month, and the bundled price reaches $12.99 when ESPN Plus with ads is added to the mix. And with these new ad-supported offerings, we're able to deliver greater flexibility for consumers. Okay, so let's see. Yeah, US import a lot from China, and China data should help with the US CPI lower as well. And yes, that is true. I think if CPI negative 0.2% is a big deflationary force within China. So that's a very good point. And again, we'll find out what happens next week, right? For inflation, I think I'm expecting some good numbers, but you never know. You never know with CPI, although energy is down substantially in the month of November. So that's a very good thing. I think the big catalyst once again is going to be shelter prices. So where rents are going to be and food. I think those two things have been really the big sort of head scratchers for all of 2022. Kevin says, got rid of cable to save money. Now I'm spending twice as much on Netflix, Hulu, and Disney Plus. Absolutely crazy. But, it's kind of strange. Like as an investor, well, not that I'm an investor in either of these companies, Disney or Netflix, but I'm just saying from an investor standpoint, this is a great strategy, right? Because you're not only generating revenue through the ad-supported tier because consumers are going to be paying for the ad-supported tiers, but also you're generating money through advertisers, right? You've got 300 million something subscribers watching your content. Let's just say that 50 million of them are going to be for the ad-supported tiers. So that's still pretty good subscriber base that you can market to as an advertiser, right? So this company generates revenue both ways, right? Ad-supported tier and advertising. So as an investor, that's a great strategy. But as a consumer, that's not. So it's kind of like you have to put yourself in those shoes and kind of understand that, okay, if I were an investor in Netflix or I was an investor in Disney, this is a great move, right? That generates more revenue. They don't even have to do anything. It's like, it's not even like they have to build the entire infrastructure around it. No, it's just all on streaming. So all they have to do is create a new tier, allow access to advertisers like these ad templates where they can pretty much create ads and whatever the interface looks like, that's pretty easy to do. And boom, you've got a whole new product generating revenues in two different ways. But then if you put yourself in the shoes of a consumer, yeah, this is not something that you want, right? So, but it is what it is. So Netflix here pushing through quite a bit, a little bit over 2% at the moment. And Netflix has been very strong, right? So Netflix has really been very strong. I think we've been talking about this and how this ad-supported tier is going to be a big lift to the overall share price. And, it's gone up like 95%, like it's almost doubled since May. And even Netflix, to some extent, would have outperformed in the last 6 months, Netflix outperformed the markets in the last 6 months, 69%, 70%. It's a pretty substantial gain for Netflix. Amazon Prime TV is really cheap. Oh my lord says Netflix and Amazon Prime rocks. I do also like Apple TV. Apple TV is like extremely cheap. Like I think Apple TV is like $5 a month. And yes, they don't have the content. They don't have like a lot of shows. I totally understand that. But there's a couple that are really good for Apple TV. So I think if the content slate picks up for Apple TV, I think it's got a lot of potential. If the pricing obviously stays that low, which I doubt it's going to be. But at $5, I think is just, you're getting some really, really good shows. So no, Apple is not with ads. Even if it is, there's a pretty good option of skipping ads. So I think I've never seen an ad on Apple TV. I've been able to skip them for the most part. I think you just see it before something starts and you can skip it, but then there's nothing there. YouTube TV I actually never tried. People have said that YouTube TV is really good, but I'm gonna try that very soon. I don't have Prime anymore, Amazon Prime. I used to, Prime TV, but I do have Netflix, Apple TV, and then YouTube I might test out. All right, so we got about 10 minutes left for markets to open. Just a quick review of what we have discussed. PPI numbers coming in much hotter than what the expectations were for everybody joining us right now. We came in at 0.3% month over month versus 0.2% expectations. Year over year, 8% was that number last month. 7.2% consensus. We came in at 7.4, so that's a double miss. And ex-food and energy, 0.2% was the consensus. We came in at 0.4%. That's a triple miss. And ex-food energy year over year, 5.9% expected. We came in at 6.2%. That's a quadruple miss. And then ex-food energy and trade services expectations, 0.2%. We came in at 0.3%. And that's, how do you say? Anyway, that's 5 misses for PPI. And then we didn't have a consensus for ex-food energy trade services year over year, but we came in at 4.9. So the bottom line is that we came in better than what the previous month numbers were. But versus the consensus, we kind of missed on everything. And the expectations for next week are still pegged at 50 basis points. That's the majority, 75%. 25% probability for a 75 basis point. And this is where we are. The majority of the gains for PPI coming in from two things. Services, when you look at core, that was the big increase month over month. So just update that here. And services, you can see that it was up over 0.4% month over month. And then when you take a look at the final demand, the headline number PPI, the majority of that increase coming in from food, which was, quintuple. How did I miss that? I'm telling you, I'm sick. I'm under the weather. Got to give me a break. So yes, quintuple miss. But yes, food's 3.3% increase month over month. So very substantial gain on food and services. And then next week, of course, we got the CPI numbers and the Federal Reserve's speech as well. Alex, is PPI a prelude to coming CPI, or they're not really related? They give us a little bit of guidance. They're not directly correlated with each other, but sometimes you get PPI numbers come in before than CPI, sometimes after. So there are two reports that kind of go hand in hand, and they definitely do give us some guidance as to what we can expect going into the CPI numbers. So any market moving events coming today? Nope. So PPI was the only thing that was pretty important, but now I don't think we have anything that's going to be important enough that's going to be moving the market. So we're pretty much done at this point for the week. So, consumer sentiment. I take that back. Consumer sentiment's coming out at 10 a.m. Eastern. So that's going to be in about 38 minutes or so. So that's also going to be very important. The consensus is going to be 56.8 right now. So that's something to pay attention to. Absolutely. But yeah, the 10-year yield's back on the move, 3.5%. We have seen TLT and TMF really perform well. I mean, this is one ETF to definitely pay attention to. I mean, it's pushed up, 20% from its lows. It's coming right back down. This is going to be a potential support to watch for TLT. That's sitting roughly at 106, 107. And of course, we've also got TMF. TMF here down 3.4%. This is also something that's pushed up 50%, 60% actually. TMF divided by SPY, and you can see that relative performance over the recent weeks for TMF. And this is where the money has been flowing to as well. You're seeing a lot of momentum in bonds, especially TLT, right? So again, if you take a look at TLT divided by QQQ, significant outperformance coming in for this ETF. So bond prices really pushing higher with respect to yields coming down. Even with respect to the Dow Jones, I believe TLT's outperformed since November. So it's done really well, 15%. Tesla here, sub 173, selling off. It was in the 160s yesterday, so 169 was that level. And for individual stocks, Apple here down, AMD down 1%, Tesla's down 44 basis points, and Nvidia for some reason just really holding up, defying everything here. Google's been weak for the last couple of days, down 1% each over the last couple of days, and it's down another 0.3% right now. And then if we take a look at percentage of stocks trading above or below certain moving averages, we have definitely pushed up. So this is the S&P 500 stocks above their 200 SMA, where we were actually at 64%. That's a pretty high number. Like, you'll notice that we were actually higher than the last couple of rallies we've seen. You know, that's quite interesting that we saw a lot more stocks get back above their 200 SMA, because if I pretty much chart out this with the S&P 500, what you'll notice is something that's actually very interesting, because you know, we're obviously much lower than where we are. That's interesting. You know, I think, all right, so this is what this makes complete sense. Can anybody guess why this might be the reason why we're seeing the S&P 500 actually make lower highs over here, whereas this right here is the first time we've got over 64% of the S&P 500 stocks back above their 200 SMA. So we've seen a very strong rally. 64% are back above their 200 SMA, much higher than the 48% here, much higher than the 38% over here. And you know, you can see this trend line pretty much pushing up, but this right here is the lower highs. Can anybody guess why that might be the case? Think about that. You know, S&P 500 is a market cap weighted index. Yes, Alex says mega stocks are more down. Correct. I think it's the smaller portion, it's the smaller cap weighted portion of the S&P 500 that's pushing back above its 200 SMA. So this has been a more broad-based rally as opposed to big tech, which is underperforming severely. So it's big tech that's lagging behind, and it's not back above its 200 SMA. That's not helping the markets get back above its previous highs. So I think it's mostly the other portion, which is the smaller market cap weighted companies that are back above their 200 SMA. They have seen a very strong rally in outperformance. That's one of the reasons why this is higher than its previous high, but the S&P 500 as a whole hasn't really found that momentum to get back to its previous high, because mega cap is holding it down. And that's true. If you take a look at Apple, if you take a look at Amazon, if you take a look at Tesla, take a look at AMD, PayPal, Microsoft, Google, a lot of these companies, they have underperformed. They're actually still trading to this day below their 200 SMA. Microsoft, below its 200 SMA. Apple, below its 200 SMA. Amazon, same thing. Tesla's far off. Meta is like, you know, beyond like the 200 SMA is in the sky for Meta. Meta's like on the ground. The 200 SMA is in the sky. Netflix, I think, is the only sort of I would say FANG stock, not even a large cap tech, but a FANG stock that's back above its 200 SMA. So yeah, very interesting what we've seen. Yep, so Kevin says because mega caps are lagging behind, mega cap are down more. Yeah, not all small caps are doing well. Again, Lucid, Pragmatic, I think those aren't the ones in the S&P 500 anyway, but you know, what we talked about was the S&P 500 and the relatively speaking, the lower market cap companies within the S&P 500 have done much better and have outperformed versus the big tech. Dewey, great live stream today. Caddy just saying thank you and like, remember. Yes, so please make sure that you drop a like, everybody. We're about a couple minutes away from market open. We've got 162 likes. Make sure that you do drop a like, and I'm not going to insert an ad for you. If you simply drop a like, all I can do is click on this button and insert an ad. I'm not going to do that. All you have to do is just drop a like, and I will just close this out. I really, really appreciate it. So just drop a like, and you will make my day. Unless you guys want to watch an ad. No, we were just talking about an ad right now for Netflix and how annoying that can be sometimes. Yeah, we got about a minute 30 here. So Justin's asking if Fed is practicing quantitative tightening, wouldn't the S&P 500 just go sideways? For the S&P 500 to truly enter a bull market, doesn't the Fed have to pivot to QE? Not necessarily. We have seen earnings grow even during quantitative tightening environments. So like I said, everything comes down to how earnings shake out, how earnings fare up, right? And if earnings are strong, comes back to this chart right here. And you know, what's really interesting is if you take a look at the market, and this is something that we have talked about in our previous videos and live stream, I think it's just a good reminder. Since the 1980s, and I think I can go back even further if I can find the data. But what this shows us is that the earnings have actually grown by 7.09% on average. Compounded annual growth rate for the earnings has been 7.09% 0.09% for the last 35 years, right? And if you take a look at the market, and this is not including for dividends. If you include for dividends, it's going to be a little bit higher, but this is simply based on that capital appreciation. For the S&P 500, it's also up 7.42%. So these two numbers are actually very much in line, right? Earnings and the S&P 500 value, they've both grown on a compounded annual basis by a little bit over 7%. So I think that just goes to show that in the short term, markets can be all over the place. But over the long term, I think the one thing that determines long-term returns is earnings. If earnings can be good, then we'll be fine. If earnings actually do end up being really bad, then yeah, good luck seeing any gains in the short term. So I think that's what it comes down to eventually. Kevin says I have a coupon for 25% on ads. Caddy, your World Cup winners are Portugal. Let's go Portugal. World Cup. Yeah, so today is a pretty interesting game. Brazil, Croatia in about 30 minutes here, and then of course Argentina, Netherlands, and then of course tomorrow we got Portugal, Morocco. But I'm rooting for Portugal. If Portugal doesn't win, then I'm rooting for France. I do like Brazil too. I do like Brazil. It's just crazy after watching 17 consecutive days of the World Cup. Just last couple days, it just felt like, gotta wait a couple more days for the next games. Because it was a break after 17 consecutive days of watching teams play. It was just so much fun. And then a couple days of no football. I was like, God. But yeah, I'm excited for the games today. Anyway, NASDAQ here down 45 basis points right now at the open. We're seeing a pretty significant gap down. The S&P is also selling off here on the inflation print. And Dow Jones down about 100 points. The yields continue to rally higher at 3.5% right now, with, of course, a lot of individual stocks also rolling over, with Tesla here up about 0.5%, which is interesting. Tesla up quite a bit, which is, we don't see that every day. Yeah, David, they would have only lost to one team. That's your country. That's incredible, South Korea. So idea, could you analyze Google's investment portfolio? They have 15 stocks in portfolio and there are good ones between them. Interesting. Yeah, I will definitely check that out. Oleg, if you could share a link, that would be great if I can find Google's investment portfolio. I think that would be very, very helpful. I'm curious to know what they've actually been putting money into as well. But I think a lot of that spend is going to come down. I think Sundar Pichai has already mentioned that they are putting some of their projects on hold when it comes to those investment projects because of everything that's going on with recession and, of course, consumers kind of slowing down on their spend. So I think that's something to consider as well. All right, so I wonder if you'll see lower than past lows when next earnings seasons disappoint. It's possible. I think, like I said, valuations will come into play eventually if an earnings start to kind of disappoint here for the market. Then, because if you think about where the S&P was, we were at 3,500, right? So if you plug in that number on this chart, if I plug in 3,500 here, so at one point, can you believe that we were actually trading at 16.2? And if you take 232 for next year, at one point, we were actually trading at 15 times earnings. At one point this year in 2022, like at one point in 2022, the markets were down to 15 times earnings, multiple. So, and right now we're back up to 18.5. So that is a pretty substantial gain for the markets. For us to recalibrate down to 15, this is where we need to be. 32, 3,300. So do you know India sent their players to the World Cup when they played without shoes and they beat France? Yeah, I heard about that. I actually do know that story from back in the 1950s. And yeah, that was interesting. I think there's in Qatar, there was like a big shoe story. They've got like a really massive shoe sculpture there where you can read up on this story of India and their World Cup in the 1950s. But of course, we haven't made it since, which is sad, but run a poll. I guess we do have a lot of football soccer fans here, so we can actually run a poll for the finals. Fine, I'll just how many possibilities are there going to be for the final, right? So, I mean, there's a lot of possibilities. I can't possibly list out all the possibilities for the final. I mean, there could be Portugal, Argentina, Portugal, Netherlands. There could be France versus Argentina, France versus Netherlands, Brazil versus, they're on the Croatia side. So Brazil versus France, Brazil versus England, Brazil versus Portugal. I can't list out all the possibilities. We'll do it after. We'll do it during the semifinals. We'll do like a poll during the semifinals because there's going to be limited possibilities. So it's going to make a lot of sense because right now I can't list out all of them. But yeah, that is going to be it for today, folks. I've been live for a long time, kind of covering the inflation print, of course. The markets are pulling back. I'm going to jump over to our Discord to share some analysis and updates there. But Apple here down 1%, AMD is down 1.9, almost 2%. Spain was terrible with their penalty kicks. Definitely they were terrible. Tesla is here pushing higher, so not bad. Nvidia is also flat. So we are seeing, again, big tech kind of mixed here. Netflix definitely pushing higher, close to 4%, with AMD down 1.8, Amazon down. And let's take a quick look on Block for Timothy. So Block here, pushing higher 2.5%. So back a little bit under $65. So we are seeing some momentum, and I would pay close attention to this resistance here at $69 for Square. So that is going to be the level to watch, and right now we're just seeing a nice momentum back up. So for the most part, it's been trading sideways. Very strong support in the low 50s and a very strong resistance in the high mid 70s. So those are the key areas, and right now we're just kind of like in the middle, back and forth. $69 is going to be that next resistance. So thank you so much for joining. I really appreciate it. As always, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. And the link to our Discord Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the Binance alerts, trade alerts, options alerts. We're going to be starting with a brand new options portfolio next year. So if you're interested in those private updates and of course following up with that challenge, the wheel strategy, you're more than welcome to. Links are going to be down below. And last but not least, 60% off on the fundamental and tech analysis courses. The bundle coupon code is going to be Christmas60 if you want to take advantage of that as well. So hope you all have a great weekend. I will see you all first thing Monday morning for our live stream. And don't forget, next week is critical. We've got the most important CPI numbers and of course the Fed speech, pretty much the last one for the year. So tune in for that. I'll be live to cover that as well. So always happy investing. I'll see you all in the next live stream. Take care.